And we're live from Switzerland. Hello, everyone. Good morning or good evening. Welcome to this webinar, Privacy for Stablecoins and Tokenized Assets, What Banks Must Know. I'm very happy to be joined today by Georg and Zahid. Let you guys introduce yourself. Maybe Georg first.
Yeah, hi, Georg Schneider. I'm currently leading our global RWA efforts at Digital Asset. We're the company behind the Canton Network and are looking to bring blockchain rails into institutional finance. Great to be here.
Thank you. And we're with Zahid.
Hi, good morning, everyone. I'm Zahid Mustafa. I head our digital asset custody and tokenization efforts at State Street. I'm very happy to be part of this panel.
Thank you, guys. So we'll split the discussion in three main sections, and then we will open the floor for questions. We will start with what privacy or confidentiality means for institutions. Then we'll discuss the solutions, the options from a technological perspective, and finally, we will conclude with real actions, what banks can do concretely and what regulators may do. So first of all, we hear the word privacy, which usually refers to the confidentiality of personal data of individuals. And we all know that from a public blockchain perspective, like Bitcoin or Ethereum, everything is public, meaning that everyone and their dog, be it in Switzerland, in the US, or in North Korea, can see what is happening. Yet we see a strong momentum for tokenized securities and stablecoins. So in terms of securities, I think next week, the US SEC is holding a roundtable about financial surveillance and privacy with some of the main actors in that space. Uh, and we do not have yet a standard solution that offers confidentiality of transactions. So maybe I want to ask you guys, from your experience in your respective organizations, which use cases strongly badly need confidentiality of transactions, of portfolios, of assets, of trading strategies, and which use cases may not need confidentiality at this point? Maybe let's start with Georg.
Yeah, so I think what we've seen emerge sort of on public chains is really that people have valued the capabilities that blockchain brings to the extent that they were basically willing to give up on privacy, right? So we've seen people use assets, use stable coins to a certain scale because they gave them all the benefits of instant settlement and the guarantee and the public verifiability. But the fact that they were willing to do that out in the open, transparently for everyone to see, I think, is because the value of that technology was large enough for them to be willing to do so. I would expect if people had an option to do this privately, then they would certainly prefer to do so. And I think we'll see as these technologies really become established that people will just default to doing things in private as opposed to out in the open for everyone to see.
So you mean the benefit of like moving money and moving stuff that you cannot move otherwise outweighs the cost or the harm of transparency?
I would say so. Yeah, if you look at like an institutional trading firm, right, that needs to balance their assets between custodians and exchanges, the fact that they can do so instantly is really carries a lot of value. So therefore, they're willing to, at least up until now, to do that on a transparent
And
chain.
if it's between custodians, you don't really see who the asset belongs to. You just see movements between custodians.
Yeah, you get a certain level of sort of privacy on that front, and I think there are definitely use cases that maybe don't require privacy at all, or where people actually do not care, right? Especially when you look at sort of more of the retail-oriented use cases like remittances, right? If I send a couple of dollars around the globe, I might not care if everyone is able to see that, right? So I think it depends a bit. We've also seen that people generally, are willing to give up on privacy. If you look at all the sort of social media platforms, right, they're willing to hand out their data for the benefit of connecting with others. But also, I think to a large extent, so far, it's simply been the lack of an alternative, right? If there is no way to transact then people simply don't do it, and they stick to the rails that they have. But I think we're at the point where these privacy solutions are mature enough that we see this optionality come upon, and especially when you think about really institutional use cases, right? When the bank wants to bring their core business onto these new rails, that is an absolute requirement, and they will never bring that onto transparency.
Okay, so if we take the perspective of a bank like State Street, Zahid, what's your take on that?
Yeah, I mean, I really agree with Georg on this. I've said this a couple of times, but the top 5 custodians hold about $320 trillion worth of assets and funds. And there is nothing new about what privacy means to institutions like the big banks. And you can just go back to the 2008 financial crisis, right? I spend a lot of time in markets, both MBS and CMBS and CDOs. One thing that was very telling right from those markets, look at what Dodd-Frank did, look at what MiFID II did, look at what the market abuse regulation did, right? It's all about bringing equity and equity-like instruments and fixed instruments and structured products to enable pre-trade transparency and post-trade transparency, right? But the data was significantly about enabling transparency, but viewable by regulators, right? So the key mantra here is that privacy does not mean that you remove auditability by the key participants who need to be auditing this, right? So it could be regulators, it could be audit firms, it could be compliance firms within respective organizations. And to have that healthy balance is absolutely critical. So we just kind of go back to, again, stress market events. You could go back to, the 2022 mini budget crisis in the UK. Imagine if before the gilt crisis, there was a view that every tokenized fund that was created, you had investors who could basically redeem their money market fund units, but everyone was able to see that redemptions were coming through maybe 10 days, 15 days, 20 days, or a month or 2 months before that actual event, leading up to the event. What would have happened is even a more prolonged crisis, because in that particular stage, you would be able to not only see the flow of redemptions, but the quantity of redemptions. And that would not just impact the money market fund units itself, it would actually impact the asset prices of the underlying assets representing the fund, right? Which would create liquidity challenges, and it would have had a significant impact in being able to redeem tokenization of money market funds. So this is where we have to be very careful, because on one end we say that it's important to tokenize money market funds so that you don't redeem out of a money market fund for cash. But I'm giving the other argument. You could have had a tokenized money market fund during that crisis, but having no privacy would have actually led to more pro-cyclical risks on underlying asset prices, which would have prevented you from actually redeeming the tokenized money market fund in the same place.
Okay,
so I'm trying to keep going back to that. It's very important.
Yeah, so in the context of banks, instead of using maybe the virtual privacy, which refers to individuals' data, it's maybe more accurate to talk of opacity, transparency, and as you say, it's the double-edged sword depending on the use case. And if we add a layer of confidentiality of cryptography, where we actually need transparency and auditability, we just turn this business problem into a complex key management problem that may create more problems.
Yeah, I think one point that also mentioned here is important. The sort of the privacy is often misunderstood, right? In the sense that if your requirement is that nobody in the world can ever see what I'm doing, I don't know that there are many use cases for that outside of maybe illicit use cases. But it's really about sort of the selective confidentiality or selective disclosure, if you will, that I want to just transact as I'm used to with my counterparties confidentially. And if needed, I want to selectively disclose to a regulator. So I think, we're often sort of, there's this misconception with privacy coins that maybe solve for a different problem. But here we're solving basically the problem of bringing privacy to this new technology in the same way that banks are already used to transacting confidentially.
But once you run into this problem, you open the door of, well, the single biggest problem in security, which is key management. If you have selective disclosure, it means you have to manage credentials, keys, revocation, access control, and it's a major headache. And you're right, the comparison with privacy-oriented cryptocurrency such as Zcash and Monero, and sometimes people mention things like mixers, but we should not confuse this notion of confidentiality, opacity, and the notions of untraceability of transactions, because we need traceability, but we need to enforce this kind of need to know. And again, what confuses many people is that we refer to privacy to protect an individual's data if they are their own custodians. If I have my own wallet, my key that I own, I don't use a custodian. But if everybody's using banks and custodians, the problems becomes very, very different. And maybe the next question, I think, Zahid, you mentioned that before. Um, we don't want to, let's say, have a regression compared to what the actual financial system offers in terms of visibility or datability. So how would you say blockchains compare to the systems we have today, the marketplaces, the payment networks, things like dark pools? Uh, how would you say blockchains compare to the traditional finance in terms of visibility?
I think blockchains are a game changer and actually are a boon to regulators and auditors and compliance folks alike, right? Having spent a lot of time during legislation which brought into account pre-trade transparency, post-trade transparency, the most complexity that the banks had and the regulators globally had on the things like MiFID II, which were extraterritorial, trading taking place cross-border, was how do you kind of get all the data across national competent authorities of different jurisdictions, right? EU 27 states, the US, Europe, APAC, all wanting to see cross-border transactions having either on principal or a back-to-back arrangement, what have you, and all that data being normalized and visualized across regulators so that they could look for things like market abuse, right? They could look for things like front running.
You mean like
And that was
travel rule
impossible
information
to
and so on?
travel rule information going across from originator to beneficiary, the ability to do transaction screening, the ability to do transaction monitoring, the ability to look for market abuse. This is an opportunity where all the data in exactly a confidential manner, which enables like opt-in confidentiality through full auditability by having the right view keys in with the right institutions, legal entities who can do that, is significant. Like I wouldn't say the overhead that the regulators had to deal with by putting together FRIDS, which is the ability to get all this data for them to be able to look at transaction reports from 1,000 or maybe 50,000 different legal entities globally, not being able to figure out what the schema is, not being able to see whether the reports were filled in completely from a completeness and accuracy standpoint, leading to transaction fines, leading to issues with all that can be removed by actually having the right reference data, right? The right ISO 222 standards that every bank complies with, so that that data from a proof of truth and a source perspective remains on the blockchain of record. And that's a game changer, right? Across the board, which
So
no other jurisdiction previously has been able to do
that's
prior
quite scary to me, having
blockchain.
encrypted data on public chains. Even if you have a sound key management system behind, we can make the analogy with biometric passports, whereby each country has their private key and the authority to issue passport. So we can imagine a scenario whereby financial institutions would have this kind of PKI to allow them to access transaction. But yeah, I'm still always a bit wary of having potentially personal data, private data on chain, even if encrypted, because the data is out there forever. I don't know, Georg, what do you think from maybe the Canton
Well,
perspective?
I wanted to add a point on this of what the comparison between what banks do today and what this will look like in the future. I always think about the current financial system. Confidentiality is maintained by essentially segregating systems and databases, right? So everybody runs their own database. So if you take a CSD, they run their own database for their books and records. The central bank does the same, runs their own system, and they're highly segregated and secured, sort of shielded and siloed off, right? And then you have complex systems that orchestrate updates across these segregated systems, in a way that you somehow get, towards, well, not really atomicity, but at least a synchronous and coordinated update of these systems, right? So take something like T2S in Europe, right? But those are systems that are billions of dollars in, expensive, and that's essentially what the technology came in to solve, right? You can now suddenly have your own databases that keep your data private on a need-to-know basis, but you have the synchronization layer really as a foundational technology that allows you to do these updates not just simultaneously, but atomically, right? And that is kind of the game changer. But from a bank's perspective, you basically want to keep the same privacy model that you're already used to. If I interact with the CSD, only me and the CSD knows it, and maybe the person that I'm transferring to, while retaining that sort of interoperability.
Yes.
Now.
But in terms of governance and control, this synchronization layer is operated by a consortium of parties which have contractual duties to keep the system running, and so it's not like a purely permissionless system, right?
It depends. I think the governance, equally to the privacy, the governance need to be sort of configurable. It needs to match certain, there might be regional constraints, regulatory constraints, might be compliance constraints. So I think depending on the use case, you do want to have sort of the flexibility to govern that interoperability layer in any way you want. But the important part is that the technology, the foundational technology, needs to ensure that all these independently governed, systems and networks remain interoperable with each other,
Okay.
right? And that's the difficulty I think that at least we try to solve for Canton Network, to have really the independence on one side, the interoperability between systems while retaining all the privacy. I think that's the sort of the triangle to solve for.
Okay.
And I think just responding to regarding your comment about privacy and PII data, like let's be very clear. We do not want on-chain PII data, right? So what the banks do today, when we go through about $5 trillion worth of transactions, you don't want the execution decision maker or the investment decision maker's information and passport information on a particular trade on the blockchain. And today regulations have done a lot of that by using concatenations of different name addresses, passport information, and that's held off chain. So if anything, we need to think about how we could utilize on-chain verified credentials such that the data still remains off-chain, but you have verifiable credentials on-chain, which then supplements the wallet address data, what have you, to be able to enable the ability to move with on-chain identity, which is quite important.
Yeah, which is typical organization of some. Okay. I had some network glitch. I hope you still hear me. So that's a good segue to the next discussion. I think you mentioned interoperability and the issue of fragmentation. And one thing that we see is a relatively large number of projects, companies at different stages of maturity offering privacy. So Canton is one of them, and maybe one of the most institution friendly. But oftentimes when people ask me about privacy and this conundrum of adding a lot of crypto and maybe throwing all the very complex crypto we have at the problem to make public blockchains private. So I mean, things like homomorphic encryption, zero knowledge proof, you name it. People ask me the question, what about just having a non-public database, a private layer, which is kind of what Canton is doing. So what do you guys think about just having a private database like some major banks are doing in the US? And what's the benefit of using a permissionless network whose governance and whose features and roadmap you cannot control? Who wants to start?
I can take a start on that. I think in the past we've seen sort of this duality, and there's either public permissionless and there's private permission, and they solved obviously for different things. I think one of the benefits, obviously, of a private permission network is that you have the necessary control over who gets to play there. You have some level of privacy, but for the most part, you're giving up entirely on the interoperability, right? While you may say, okay, I have maybe some interoperability within that network, you're always looking at really like a siloed network that won't be able to interact with all the rest of the apps. So the approach has some merit, but it's severely limited in terms of how it can scale, right? And then on the other hand, the sort of the public permissionless side has always solved for the interoperability to start out with, but have now sort of finding themselves in the situation where they see the need for privacy, and that's where some of these solutions come in that try to tag on privacy onto an entirely transparent chain. And I think that is a very difficult problem to solve. That's where you need, really complex cryptography. And I think where we try to strike sort of the middle ground here with Canton Network is that we've thought about privacy from the get-go because we started out by selling to FMIs and large banks, so we knew the requirements were there. So we built in privacy into the core of the technology in a way that's actually very easily understood. It's plain old, data segregation. Only parties that need to know have the data. So that's what we've pretty much been doing since the past, 50, 60 years. Yeah. So it's very well understood. It's very old school, and it doesn't use some of the sort of novel crypto techniques, which do have their place.
I mean, that's what I like with Canton. Your cryptography is very boring and simple, which is a compliment because it's reliable, it's battle tested, and it's easy to audit. So.
Yeah, and I think that those cryptographic techniques they definitely have their place. And there's use cases where they're perfectly suited. I think for large scale, systemically critical financial infrastructure, it's just a bit too sort of bleeding edge, and I think they need to stand the test of time before people are comfortable interacting with. And we can go into a bit more detail on some of this.
Good. So I know that State Street has done this exercise of comparing different technologies, public, private, semi-private. Zahid, what's your take?
Listen, I totally echo this with Garrick, right? Like for us, there are some two key areas. So I'll probably break it down to the first is if we look at tokenized funds or tokenized securities, right? And let's just say they were completely digitally native on a decentralized public permissionless ecosystem. One of two things happens. If those tokens are hacked, completely digitally native, I don't have any recourse to any issuer, right? I don't have a recourse to any platform provider, which is a centralized organization who could basically, at that given stage, claw back or waive or burn those particular tokens, right? And that's very important from a trust perspective that you have some form of permission validator set that you can go back to that actually owns that, right? So either the sequencer themselves is centralized, have the appropriate governance. They could be a multiple, sequencers as part of some type of committee that, again, are well-established institutions that kind of go through KYC, AML. So I think that's absolutely critical. The other piece is about, like pure, cryptocurrencies. You could sign a transaction and be on the mempool, and a sanctioned validator can basically pick up the gas fees, right? And so how do we kind of deal with that and create an arm's length where institutions like ourselves, I mean, the answer could be very clear right now. That's never happened once. But as you get more and more tokenized assets and funds and securities on the blockchain, eventually that answer that this has never happened before is not sufficient. So how do you create arm's length between us as banks and the blockchains, which are public permissioned, I would say permissioned in nature, that provides a permission validator set that creates recourse as a platform, and then that manages how we actually deal with, how the actual gas fee or transaction fee is actually transacted in. That makes the entire ecosystem quite safe.
Yeah, and all the protagonists of the system, there is a notion of accountability, of governance, of third-party risk management, which banks need, and I know this well as a supplier of State Street. So maybe I want to ask, not you guys, but the audience. We have a number of people. We're happy with the number of participants this morning. You will see a poll appear in this webinar application to ask you which privacy technologies you guys are familiar with or have heard about. You should be able to answer multiple to give multiple answers to that. So Diana will launch the poll, and it should appear soon, and we'll see the results. Because I'm very familiar myself with many privacy technologies. As a cryptographer, I'm very excited, but I'm still pretty scared and curious of how this will be able to scale when I see the massive level of complexity. Okay, so I'm gonna ask you now a hard question, um, maybe more to one to Georg too. You don't have to answer. You don't have to give a simple answer, but if you had to choose one solution today to tokenize, um, I don't know, securities or oh, Zahid's gone. Might be a connectivity issue. I think he will be back. So maybe I can ask Georg, what would be the value proposition of Canton, where Canton stands out compared to the competition, and what would you say are maybe Canton's limitations or what Canton cannot do that others will do? Oh, welcome back, Zahid.
Yeah, happy to lay this out. So I think in terms of privacy, we have a very unique approach, and I think the only one that we think is really suitable for institutional finance at scale for systemically critical flows. And as I mentioned earlier, it's sort of very boring, as you said, and old school, using data segregation and distribution on an eternal basis. And I think that's that on the one hand sets us up to get those segments of the market onto this new technology. I think one aspect where I think we need to sort of work on and figure out how to do this properly is public verifiability, right? There is a lot of sort of trust that comes with people independently being able to verify, and also other parties outside of a given transaction to verify the validity of the transaction without being able to see, right? So I think that's one aspect that we're working to figure out what the best solution is and what's a solution that works for the market. I think in terms of comparing this to some of the other technologies that you've mentioned, there's a lot of active research in these areas, but I think we've seen some points where you can see the limitations. Let's take, for example, zero knowledge based approaches like privacy pools and the likes. Just recently there was this hack at Upbit exchange, and the hacker actually managed to create this proof of innocence to enter into a pool, right? And now you suddenly have the problem that
I like the rail gun. Yes. Yeah.
Tainted, right? Yeah, that was through the rail gun approach. So I think these solutions are being sort of tested out and validated, what works, what doesn't. But the risk of putting critical flows through them, I think, is still not well understood, and therefore might not be viable for the institutions. On the other hand, you have you mentioned also fully homomorphic encryption. I think a very promising approach. I think there currently you still run into the limitation of what can you actually make private, right? Because ultimately to bring complex finance on chain, you actually need privacy for everything, not just, let's say, token balances or transfer amounts. If you think of something like an ISDA CSA contract, right? Highly confidential, but has a lot of complexity in it, eligibility schedules, all sorts of different parameters that people want to keep confidential, but also where there's a great benefit of bringing them on chain. So if you want to do these things on chain, you need the full kind of fine-grained privacy and programmability around this. And I think that's where fully.
Yes. So maybe I can give a quick recap for the audience from my perspective as a security technologist. I would say there are three levels of privacy in the context of blockchains. The first one is where only numbers are opaque, encrypted. So numbers mean balances, balances held by addresses, and balances sent, transferred. So in that case, the addresses, the recipient, and the sender are not encrypted. you can see that address A is sending money to address B. And if later on you realize that address A is Gerard and address B is Zahid, then you know that he sent this amount, he sent money to Zahid, but you don't know how much. The second level is what cryptocurrencies like Zcash are doing, whereby not only the numbers, but also the addresses are invisible, are opaque. So you don't know who sent money to whom, you don't know which address. And the third layer is where also the program, the smart contract, is opaque, where you see that something is being done, the state is changed, but you do not see the smart contract. You don't know what the smart contract is doing. You just know that there is a smart contract somewhere. And the last point I want to make, because there's a lot of confusion around this. So ZK as in zero knowledge. So it's tempting to think that zero knowledge means that there is no knowledge or no information. However, most of the time you hear ZK, it's not to hide the knowledge. If in ZK as in ZK rollup, uh, it's a technique just to make blockchain scalable, but ZK rollups do not give you any sort of privacy. It doesn't even give you privacy of the numbers. So ZK rollups are not a privacy technology; they are scalability technology. Although some systems do combine ZK rollup and privacy, like Aleo, but that's another question. Okay, maybe let's move on. Let's move away from technology and now to institutions and banks, and maybe a question to Zahid. Um, what would you recommend to banks? How to prepare um, to a future where we may or may not have some level of confidentiality, just in a very broad way, not just about using some technology to solve a problem, because the problem can be addressed in multiple ways in terms of processes, in terms of governance. First of all, do you believe that tokenized assets are the future? Which tokenized, which assets, um, and what role can technology play in that future?
Yeah, this is a good question, JP. And to some extent, what Canton is doing here becomes quite important. Think about why are we tokenizing, right? The intent is not to tokenize for the sake of tokenizing, right? Tokenizing needs to lead to an outcome that clients want to get to, right?
Mm.
And one of the killer use cases that are out there, and there's no surprises around that, is we have a $26 trillion collateral market today, right? Which can be made far more efficient because you have trapped liquidity today in corridors that is extremely expensive and makes the ability to move collateral seamless across the globe almost unpractical, right?
Yeah.
So imagine using in that $26 trillion market, about 2/3 of that collateral market is bilateral, right? Just between two counterparties like Georg and myself. Imagine where the trust between two counterparties is preserved using DLT or whatever the means is of exchange of collateral to demonstrate that the other party can be trusted and can be made whole.
Mm.
This entire industry in banking is all dependent on trust. And trust can dissipate very quickly. We've seen that when FTX went bust, which
Yeah.
was a small precursor of what happened during the great financial crisis. And so my whole takeaway is all assets and funds will move onto the blockchain because it enables interoperability and movement for use cases such as collateral, for other use cases such as distribution to new client market segments who want to basically grow more yield. It can be opened up to wealth managers and private banks who want to now be able to use fractionalized asset components as opposed to having large institutional mandates. The buy-ins for institutional mandates could come down, and so it democratizes the accessibility for folks as they move from retail up the wealth curve. But
Yeah.
all this requires a form of trust. And then, to last but not the least, I think the most biggest untapped market is the residential and commercial real estate market, which is a $400 trillion market today. So imagine when mortgages that are underlying mortgage-backed securities in the future that you're able to get that information on the blockchain where rents and yields can be paid on a particular blockchain, but you have transparency, right? That protects the rights of individual homeowners who are basically paying into those particular mortgage pools, but still builds trust because of their ability of their score and their ability to make timely repayments. The whole value chain from retail to professional to eligible counterparties moves on chain, but it has to operate within a matter of trust. And trust is preserved through the likes of, what I would call privacy, but or confidentiality, which doesn't lead to anonymity, right?
Yeah.
It still has to lead to pure auditability.
I really love what you're saying because when you mentioned trust, you cannot engineer trust. No matter how much crypto you solve at it, trust is not a technical problem. It's an economical human problem. It's like sometimes I hear cryptocurrency, people telling me that we can solve inflation by throwing crypto at the problem. No, inflation is not a technical problem that you can solve with algorithms. Um, I don't know, Georg, what do you think of this? And maybe you interact with a lot of banks, institutions. What do you think they are doing or thinking right or wrong?
Yeah, so having worked for just about 8 years now with the banks trying to adopt this technology, there's sort of two areas where I see them, maybe going down the wrong path or taking some wrong decisions. I think banks and generally large institutions, not I don't want to pick on banks here in particular, but large institutions usually suffer two problems. One is the not invented here syndrome, so they're trying to do everything themselves, and the other one is sort of the boiling the ocean problem. They want to do everything in the first step, right? So the first one, we've seen, banks wanting to build their own wallet stack, which is completely not their core business, and there's super well established solution out there. Taurus Protect is a fantastic product that lives up to the highest security requirements that any bank or FMI would have. So there's existing solutions that you can just buy off the shelf. So don't invent where you shouldn't be inventing. Focus on where your core business and core differentiation is, right? And then the second one, sort of the boiling the ocean thing, is really that this is a novel technology. There's many different parts throughout the organization that need to get comfortable with it. So take baby steps, take small steps, do the sort of crawl, walk, run, right? And to Said's point, like collateral is indeed a huge opportunity. Because the path to value realization is actually fairly quick. Just the instantaneous movement of assets already is a game changer in that segment, right? And we've just, case in point, this Sunday executed a transaction amongst the market participants that would see a swap of an on-chain US Treasury versus an on-chain Eurobond, right? Something that, first of all, couldn't happen on a Sunday before, and would take probably 2 days to settle, on traditional rails, and we did it on a Sunday, and it settled instantly, right? So I think the opportunities are there, and you just need to sort of think about taking small steps, right? That transaction was full of one-off agreements, one-off approvals, all these type of things. Well, we got it out the door, we sort of pushed through, and that was a meaningful first step. And then you go figure out how to scale it up from there, right?
It's really hard for banks because as tourists we talk to a lot of financial institutions, and more often than not they're very confused, and rightfully so, because from my perspective there is a large misalignment between the interest of banks, of the real economy, and technology providers, especially when they come from the what we call the DeFi world, where it's companies built by engineers for engineers to some extent, and who have a limited understanding of the needs of the market. So they have this maybe utopia of reinventing finance, and this intention of bringing new tools and more efficiency, but sometimes they would need maybe a better knowledge of history and of what markets and banks actually need. So tourists, we are at the intersection of technology and finance, so we try to have a good position. But yeah, I hope we converge towards a future where technology is better fit for the market, and there is less fragmentation, and there is less, let's say, hype where every 6 months some cool new protocol or blockchain comes out, and some of our clients come to us, we want to use that, and 6 months later they change their mind because that's what they sometimes do.
Maybe
Okay,
to
so
add,
yeah,
sorry for me, you make a point around some of these, novel DeFi protocols and all the sort of experimentation and innovation that happens there. I do think it has its merit, but I think where it kind of where it's limited, or where people are maybe approaching it the wrong way, is that we're trying to bring the financial industry onto new technology rails, right? And you cannot at the same time try to reinvent market structure, right? The two are just too much to swallow. I think once we let people do business as they used to be doing on these new rails, and they get comfortable with the technology per se, I think there's room for also these large and institutional finance players to try out maybe some new economic models around liquidity pools and all of that. I think there's definitely merit to that, but it's like, again, back to the sort of boiling the ocean into.
And I think real banks with real money should really stay away from some technologies, which are, from my perspective, really a regression in terms of fundamental security principles. But anyway, I think it's time for questions. We have in the chat already 2 questions. The first one, I'm not giving the answer because I don't even understand the question, but maybe you guys do. Someone is asking, how will DAC8 impact transaction anonymity in EU and outside? Does that speak to you guys? What is DAC8?
I'm just asking ChatGPT.
Okay.
I don't know.
Okay, maybe another question. Someone is asking about tax aspects and corporate actions. They're saying they are likely to be always put aside during working groups. Is it because these topics are too challenging to be tackled with blockchain ecosystem and privacy? So I can give the embryo of an answer on that. Because so corporate actions, there's different types of corporate actions, but as far as tokenized equity is concerned, at least in the case of Switzerland, there is quite an established framework to deal with a number of corporate actions, such as dividend distribution, split and reverse split, which sometimes give you the freedom to do it either fully on-chain or off-chain, or in a hybrid mode, on-chain and off-chain, as long as you retain compliance with whatever regulations you have to comply with. DAC8 is some reporting framework. Okay, I learned something today. So, any other question, guys?
I guess it's the only other point around why that might be difficult is just remember, we're not just talking about digitally native securities or digitally native funds that are paying income on corporate action events, right? So again, going back to that 320 trillion, those are existing assets, those are existing securities, right? So if we then represent that onto a blockchain, right, and you can have a traditional fund and a digital share class, you're still getting that dividend distribution for that share class on chain, but then you still have to deal with the dividend distribution for the traditional share classes which are not on chain, right? And clients want to be able to see their dividend distribution across their on-chain portfolio and their off-chain portfolio. And so we have to always keep in mind that we're going to be in this hybrid ecosystem for at least another 5 to 10 years, which means you have to deal with the core custody cash asset servicing systems that incorporate corporate actions like for muni bonds or corporate bonds, or if there's early redemption payouts or movement from fixed to floating or floating to fixed. And the data needs to be homogeneous across both on-chain data sets and off-chain data sets. So I don't think it's always about digitally native. It's about integration to upstream and downstream systems.
Yeah, I
And
actually wanted to make a very similar, almost the same point that corporate actions is an insanely complex topic. There's whole companies being built around to solving that problem in TradFi, right? So, and in terms of the value realization that I've mentioned earlier, is that if you just bring the asset down sort of token, on chain representing the asset, that already gives you some value by the instant settlement nature and so on. Doing the corporate actions is sort of, to me, or generally the life cycling of the asset is kind of the holy grail. But to Said's point, there is a huge amount of sort of legacy infrastructure, and unless you're able to decommission that, you don't sort of remove complexity, you don't realize value. You're actually adding complexity. So that's why we've seen parties really focusing on the first steps. And then eventually, I think we'll see these things come on chain, but it's not the first problem to solve for.
yeah, and it's also a new risk, a new attack surface. Uh, I have a question myself to you guys. So in the title of this webinar, we have the word stablecoin. We haven't talked much about stablecoin. Every day there's a new stablecoin project, a new company doing its own stablecoin. If we look at the bigger players like Circle, like Tether, a number of them claim to have a roadmap or a plan to have a private privacy mechanism. Um, I don't know what to think of that. Do you guys think that private stablecoin will be popular, assuming that we have all the let's say compliance features, or do you think stablecoin in 10 years, if they're still around, will work without any privacy at all?
I'll take a shot. I think stablecoins will definitely see privacy. Again, the most projects that we see out there are sort of again trying to kind of tag on privacy onto their existing transparent rails. Others are taking different approach. Many of them are coming to Canton. I think ultimately we'll see kind of a range of different paths that the stablecoin can take, right? A range of different routes. And depending on the user preference, they might choose, private transaction. They might choose, I want to do cheapest, fast, and I don't care about privacy, right? So just give the user the option, and then they'll be able to choose what fits their requirements ultimately. I think for stablecoins to access the next level of scale, generally, sort of to be used in high-value payments, cash like over repo or so, privacy is a requirement. So I think that will definitely present a big unlock for them.
Okay. Zai, did you want to add something?
Yeah, no, I just wanted to just echo the point that where stablecoins are being used is a settlement asset, which is not a security, right? And so to the extent that like the US, the Global Markets Advisory Committee is now looking at how stablecoins could be used as a form of eligible collateral, right? And then kind of goes back, right? Everything's about trust, whether I do this as bilateral between two counterparties or multilateral or tri-party, you're not going to actually suddenly show the payment leg of a particular stable coin, which doesn't have the preserving features that would be required and having the auditability associated with it. So I think anything that touches the way cash today, a stable coin is another form of digital money, but it has to adopt by the same capabilities that enable trust in the financial ecosystem today, right? So I don't think that changes.
What scares me as a security person, and I've seen a lot of security disasters in my life, is that we should not forget that stable coins and cryptocurrency is a system where if one sequence of 32 bytes is stolen or lost, then the whole stablecoin and part of the economy collapses. If someone gets access to the Tether key, then, well, we're in a very bad place. And we don't have this point of failure in the classical ecosystem. So I think the question is not if, it's when we have this kind of disaster for which type of stablecoin. And it's a problem that we don't have, or we have to a much lesser extent for tokenized securities, at least in some jurisdictions.
So JP, I do want to bring up this point. The great financial crisis is a great lesson for this, right? Is we had a situation where you had, private label or government-backed prime agency mortgage-backed securities,
Yeah.
AAA regulated, right, with the full explicit backing of the government, where the underlying loans were
Yeah.
basically super prime, and they were at cents to the dollar. So this eventually comes down to one point. Once the trust is lost on the credit worthiness of the issuer, the
Then
the
domino.
the history then comes back to the underlying, right?
Yeah.
And the underlying could be T-bills less than 93 days, but if there's a fire sale on US treasuries, which makes up like 200 billion of the 300 billion stablecoin market today, and if you extrapolate that to 2 trillion, it will lead to cataclysmic
Yeah.
issues, especially where stablecoins have been used as collateral or they've been encumbered, and you're now trying to get out of a position where you want to redeem a money market fund, for
Yeah.
example,
We're not
right?
getting
So it
rid
comes
of
down to
those trust
trust.
assumptions. So we're just stacking more trust assumptions on top of the legacy ones.
I
So
think
That's
actually
correct.
that presents an opportunity for the banks as well, right? The banks exist because they are institutions of trust. Traditionally, they have been for hundreds of years, right? And there's an opportunity sort of on two fronts. I see one is bring tokenized deposits, just your standard kind of bank accounts onto these new rails, make them as efficient as stable coins, and the other one obviously being like do a stable coin, but maybe do it in a consortium fashion or so, where it doesn't mean that if a single bank messes up, the whole stable coin is like gone or the trust is lost, right? You can also like the decentralization and distribution of trust is actually something that I think we can learn from these ecosystems that have come up. That might be a more safe and sound way of operating certain aspects of financial systems going forward.
Okay, to
Yeah,
conclude,
I would totally agree.
yeah,
Yep.
yeah. I'd like to conclude with two of the questions from the audience. I think pretty straightforward ones. One question is, who is legally entitled to see which real world and on-chain data at which stage of the token life cycle? And how is that enforced across technology, contracts, and regulations? Oh, so it depends, but I'll let you guys take it.
Yeah, I guess
Well, I mean, at least, go for it. Yes.
Well, that's exactly how I would have started. Like, it depends, because different regulators will have different requirements. I think the important thing is that the technology accommodates the different models, so it should be configurable to the extent that you can always match what the respective jurisdiction or regulation requires.
Yeah.
And also contractual terms, right? So we've talked about is there CSAs and other contractual obligations related to eligible collateral types, and prepayment schedules or product schedules that need to have payouts at different prepayment speeds.
Yeah.
All that is again subject to contractual and legal and jurisdictional requirements.
And what is somehow demanded from my perspective as a cryptographer is that in many, not all, but in many of those systems, you don't have the concept of key revocation or key rotation, meaning that if you run out of luck, you lose your key or the key gets compromised, which sometimes happen, you don't always have a way to restore security. So it's a whole new threat model. Another question is about quantum computing. What are the issues and opportunities with quantum computing as far as privacy is concerned? So I'll take this one. So again, quantum computing may or may not exist in, let's say, a horizon of 5, 10, 20 years, 50 years. My personal view, which is quite controversial, is that I will not see public key cryptography broken in my lifetime by quantum computing. You can see what I say about this in my blog. But to make it short, the clear recommendation here is that you should not put encrypted data on a public blockchain if that data would be compromised where a large quantum computer created. More broadly, I also advocate for not putting private data on chain. I gave a talk at DevConnect a few years ago about that, and really minimize your data footprint, minimize the public data you just put. I mean, that's a security aberration for me to put all your financial data on chain. I mean, as an individual, and even more so, putting private data. So, like Zahid mentioned, you're not putting direct travel rule information. You're not putting encrypted PII on chain, because who knows where the decryption key will end up. And last part, quantum computing, blockchains is good to remind everyone that Bitcoin, Ethereum, and most of the chains are not quantum safe as of today. Most of them have plans, but I think it's not a major risk. Okay, so thank you guys. I don't know, Georg, Zahid, do you have closing words?
Go ahead.
Yeah, I honestly thoroughly enjoyed the conversation partnering with Georg and JP. I think this is a really opportune time. We're going to see a significant wave of tokenized assets, funds, securities, with different forms of digital money. And as this entire industry moves forward, the lessons from the past are extremely important, because as JP pointed out, you're overlaying additional controls on an ecosystem that has already been hardened in financial markets. And if we can find a better, safer way of ensuring that trust can be preserved, I think we'll all be better for future years to come.
Yeah, from my perspective, just to add, I'm really looking forward to the new year, because I think I'm convinced that 2026 will be sort of the inflection point where we'll see all the large banks starting to interact with blockchain in meaningful ways, in scalable ways, and really we sort of we'll see business come at scale and become more efficient, and we start to reap some of the benefits of the past 12 years of trying to bring this technology into finance.
Yeah.
So thank you. It was great to be here.
Yeah, thank you. I mean, that was the coolest webinar I've ever done, to be honest. And also, I'd like to maybe emphasize that, to paraphrase John Boyd, it's people, ideas, and technology in this order. So crypto will not magically solve privacy and all those issues. It's about regulations, it's about process, it's about a whole lot of things. And yeah, I'm very excited to see what's going to happen. It will take a lot of time because it's a complex problem. And small commercial plug, if you go to the blog page of Taurus, blog.taurushq.com, we have a few posts about this. We did a prototype of a private stablecoin, of private tokenized security. So don't hesitate to check this out and contact us if you have any question. Okay, so thank you, Georg and Zahid, again. Thank you to the audience for participating, and see you next time.
Thank you.
Thank you.